If you have just celebrated your 40th birthday, you've probably caught yourself wondering many new things, and life insurance is one of those. Maybe you have started Googling the best retirement savings plan because retirement suddenly feels a lot closer than it used to. Are you worrying about how much life insurance you actually need at 40? And is what you have right now enough? Now let's imagine something for a moment. Think back to when you bought your first term insurance policy. You were probably around 30 with an income of 10 lakh rupees. No children, probably no home loan either. So you bought a 1 crore term plan? It felt like more than enough. Today you are 40, a senior manager making 24 lakh rupees with 2 children. You've upgraded your house, so you have a home loan of 70 lakh rupees. And your parents are now financially dependent on her. But your 1 crore term cover, that hasn't changed. Everything else has. In the next 10 minutes, we are going to go through exactly what you need to review, what you need to fix, and what you need to add to your portfolio at 40. Because at 40, most people find 3 massive gaps in their planning. Their term cover is too low, their retirement savings are insufficient, and they are completely missing critical illness or pension products that become highly relevant in their 40s. Let's fix that today. Let's start with your foundation. How do you recalculate how much life insurance you actually need at 40? We covered the DIME formula in a previous video, which stands for debt, income, mortgage, and education. When you apply that formula to a 40-year-old's life, that original 1 crore rupees policy falls severely short. In fact, IRDAI regularly highlights this growing gap between a person's income and their actual life cover, which leaves families heavily exposed. So if you find yourself short, how do you fix it? You have 2 options to top this up. First, check if your current policy has a life stage event feature that allows you to increase your sum assured without a new policy. If it doesn't, you simply buy a second standalone term policy to cover the exact difference. If I'm reviewing my portfolio, should I just scrap my old policy and look for the best life insurance plans in India right now and switch insurance companies? This is a question we hear all the time. Now let's answer it. The short answer: the bar for switching should be extremely high. At 40, you likely have about 20 years left on your original policy term. You should absolutely do a health check on your current insurer. Look at their claim settlement ratio trend over the last 3 years and check the current solvency ratio on IRDAI's annual report. But remember the switching reality. A brand new policy at 40 is going to cost you significantly more than the one you locked in at 30. You should only consider switching if there has been a material serious deterioration in your insurer's CSR or solvency. Marginal differences are not worth the premium jump. You aren't just topping up old policies. Your actual risk profile has fundamentally changed since your 30s. There are 3 specific products you need to consider adding. First, critical illness cover. The statistical risk of severe health events like cancer, heart attack, and stroke rises significantly as we enter our 40s. Second, a pension plan. We'll talk about this more in a second, but retirement is now only 20 years away. Third, a review of parent dependency cover. If your parents rely on you financially now, their healthcare and living costs must be factored into your life insurance. Think of these as additions to your existing foundation, not replacements. For instance, Aditya Birla Sun Life Insurance offers specific term top-ups, critical illness riders, and pension solutions that are highly relevant to this exact age 40 rebuild phase. Let's talk about the urgency of retirement. When you were 30, retirement was 30 years away. Today it's 20. 20 years might still sound long, but the massive compounding advantage of your 30s is gone. Every single year you delay now has a much heavier impact. If you're searching for a good retirement plan in India, you'll quickly realize that a dedicated pension plan is one of the common things missing from a 40-year-old's portfolio. So, NPS helps you systematically build a retirement corpus while offering tax benefits. At retirement, part of the corpus is used to create a regular pension through an annuity. And a life insurance pension plan helps you accumulate funds for retirement and plan for a steady income after retirement. It can also provide life cover while you are building your retirement corpus, combining retirement planning with protection. The takeaway for today is, you cannot defer this any longer. This is your first step. Let's bring this all together into a structured checklist. Grab a screenshot of this. Step 1. Term insurance. Recalculate your cover with your current income, your new loans, children's costs, and parent dependency. Top up if you are short. Step 2. Insurer health check. Verify your insurer's 3-year CSR trend and solvency ratio. Keep a high bar for switching. Step 3. New additions. Add critical illness cover if you don't have it, and a pension plan if your retirement savings are falling behind. Step 4. Existing ULIPs. Check your fund allocation to ensure it matches your new, shorter horizon. You might need to switch to a more conservative fund. Do that rather than surrendering the policy completely. By following this checklist, you're actively building a portfolio that reflects your life today. If you are ready to start this process, ABSLI's term insurance top-up options, critical illness riders, and pension plans are highly relevant to the age 40 rebuild. You can find detailed product information, explore your options, and get a quote through the link in the description. Now let's answer a few questions you might still have. Can I increase my term insurance sum assured at age 40 without buying a new policy? Some term policies have a life stage increment feature that allows you to increase your cover without new medicals when you marry or have children. If your policy doesn't have this, or if you've exhausted the limit, you will need to buy a second, standalone policy to cover the gap. Is it worth switching life insurance companies at 40 if I find a better option? Usually no. Buying a new policy at 40 will attract significantly higher premiums than the one you bought at 30. You should only consider switching if your current insurer has shown a severe, multi-year decline in their claim settlement ratio or solvency ratio. What critical illness cover amount does a 40-year-old in India need? Financial planners generally recommend a critical illness cover of at least 3 to 5 times your annual income. This isn't just to pay hospital bills, it is designed to replace your income and cover out-of-pocket expenses while you are recovering and unable to work. Should a 40-year-old surrender their existing ULIP or endowment plan? Generally, surrendering an older policy is not advisable, as you lose out on the accumulated benefits and compounding. Instead, review the fund allocation within your ULIP and switch to a fund that aligns with your current risk appetite. How much should a 40-year-old be saving for retirement each month in India? This depends entirely on your desired retirement lifestyle, but a common rule of thumb is to save at least 15% to 20% of your current income specifically for retirement, adjusting upwards if you started late. Does a 40-year-old's existing life insurance automatically account for dependent parents? No. Unless you explicitly calculated their ongoing healthcare and living costs into your original sum assured, your existing policy likely does not cover this newly added financial dependency. Take an hour this weekend. Pull out those old policy documents, rebuild your plan for the life you have today, not the life you had 10 years ago, and I'll see you in the next video.